Let's dig deeper into the state of market sentiment with our next guest. Assuming we get a rate hike later this month, he does see the Fed skipping in September, followed by another hike in November, pushing his recession expectations back to the first half of next year. Joining us at Post 9 today, Citi's chief U.S. economist, Andrew Hollenhorst, is with us. It's always good to have you, Andrew. Welcome.
Thanks very much.
Would you say your mood has brightened?
A little bit. I mean, I think it's right that we're revising down the probability of a near-term recession. That does keep pushing out. A lot of people thought we'd be there already, pushed to the back part of this year. Now it's pushing off into 2024. And from a market perspective, maybe pushing beyond the kind of relevant time horizon.
What about the argument that was made after pretty nice downside surprises last week that in order to keep the annual rate as low as it is, you'd have to do some pretty mild month-on-month changes, right?
Yeah, so there's been a lot of good news on inflation over the last week or so. I do think we want to be careful here and say that 1 week of better inflation data does not a new trend make. We're still running really 4% to 5% underlying inflation. So the U.S. economy would look great if it wasn't for this problem with inflation. That's probably something that we'll have to come back to maybe later this year, maybe early next year. If the expansion continues, then that's good news for economic growth, but it becomes harder to see why inflation slows down. So I do think that issue is out there, but just probably not a near-term one right now.
Well, I mean, those that are rooting for inflation to go all the way down and betting on it would argue that it hasn't been just this report. It's been ever since last summer when inflation peaked, and we've just seen a stair-step down of moderation.
Most of the moderation that we've seen has really been in gasoline prices and food prices and those headline items. You do see the core slowing down. Shelter prices are slowing down, but if you think about the fundamental drivers, we still have a very tight labor market, and we still have a tight housing market despite mortgage rates being higher. So we're seeing these upside risks to services prices, upside risks to housing prices. Again, you're probably not really going to see that in the near-term data, so I think we can continue in markets in this kind of, dovish reprieve. But as we get towards the end of the year, maybe we're going to see some more of those upside risks to inflation emerging.
Yeah, I mean, the pay numbers that we hit this morning, that they're now outpacing inflation, is problematic for the Fed. So I mean, there's a case to be made there. Why do you think it's every other? Powell at Sintra said he's not ruling out consecutive.
Yeah, I think that they really were unsure what to do at the June meeting, and that's why we got this kind of strange messaging where they decided not to hike, but to raise the dots that indicate they would probably hike 2 more times this year. Now we'll get the hike in July. The market really hasn't changed the pricing of that. That's kind of baked in the cake. And the question becomes September. September, I think, is going to look a lot like June again, where they just want to be cautious. And I think you have to think all the way back to March, April, when we had those issues in the banking sector. It's really not on the near-term dashboard of markets right now. But when the Fed thinks about raising interest rates, they're aware of that risk from financial markets, and they want to be cautious as they're raising rates further.
Street's looking at some potential negative payroll prints in the back half of the year. On the other hand, some of the labor deals that are getting put together at the airlines, for example, 13, 18% pay hikes immediately. I just wonder do you see relief in wages in the next year?
That's exactly the point that I was making, that with these really tight labor markets, labor has a lot of power here. You are seeing these wage increases in certain sectors, certain wage negotiations where you're seeing sometimes more than 10% wage increases, to your point. It's really hard to get inflation down in that environment. Now, if you got negative payrolls, you'd have a higher unemployment rate, you'd have a looser labor market. There'd be reasons to think that wages can cool. It's not what we're seeing in the data right now.